A lot of investors think the path to building wealth is buying one single family after another. That's what most books teach, and it's what most social media influencers actually talk about it. It's what a lot of new investors naturally gravitate towards. The problem is that in today's market, that strategy could be limiting your growth, reducing your cash flow, and increasing your risk. If you're serious about building long-term wealth through real estate, you need to understand why small multifamily properties are becoming one of the most attractive investment opportunities in 2026. Hey, before we get started, do me a favor, hit the like button, subscribe to the channel, click that notification bell so you don't miss future videos on real estate investing. Stick around to the end because I'm going to give you a checklist on exactly how to do what I'm talking about here. I'm Bud Evans. I'm a 35-year Air Force veteran, a 13-year police officer, retired. I'm former mayor of Cinnaminson, New Jersey, and an active real estate investor focused on single-family and small multifamily properties. I mentor veterans and first responders who are looking to build wealth through real estate. I also founded an investor-focused property management company in southern New Jersey designed by investors to help investors protect and grow their assets through practical systems and operations. So let's talk about what most investors believe. The average investor enters real estate through a single-family rental. On the surface, it makes sense. Single-family homes are familiar. Most people have lived in one. Financing is pretty straightforward. Management seems simple enough. The property often attracts long-term tenants. None of that is wrong. And in fact, if that's the way you want to go, I will help you out with that. The problem here is that investors usually stop there. They build an entire portfolio around single-family rentals without ever examining whether the strategy is still the most efficient use of their time and their capital. So here's where problems might start. Let's say you own one rental property generating $2,000 a month in rent. Everything looks great until the tenant moves out. Now your vacancy rate isn't 10%. It isn't 25%. It's 100%. Every expense will continue. Mortgage, taxes, insurance, maintenance, utilities. But the income, it's going to drop to zero. A lot of investors don't realize how fragile the situation actually is until they experience it firsthand. And it hurts. Now let's compare that to a quadruplex of 4 units. Assume each unit rents for $1,500 a month. Your total monthly income is now $6,000. If one tenant moves out, you still collect $4,500. You still have income covering most of your operating expenses and all of your mortgage. Instead of losing 100% of your income, you've lost only 25%. That difference becomes extremely important when markets soften, repairs come up, or unexpected expenses are going to happen. But here's where it becomes even more significant. A lot of investors today are operating with higher interest rates than they became accustomed to during the years following COVID. We're not getting them at 3% anymore. Insurance costs have increased dramatically, especially in Florida and in a lot of other states. Property taxes, they continue to rise. You can't change that. Maintenance costs, again, significantly higher than they were 5 years ago. The margin for error here has gone down. It shrunk. A property that looked promising and acceptable on paper 3 years ago, it might not even cash flow today. And that's forcing investors to ask a different question. So instead of asking, what can I afford to buy? You need to ask, what produces the strongest return with the least amount of risk? And that's where small multifamily starts changing the conversation. I see this all the time when I mentor veterans and first responders. Someone comes to me and they want to buy their first investment property. They're focused on a single family home because that's what they've always heard is the safest option. Then we start running through the numbers. Now we're not talking about a house hack here, right? We're talking about a single family home. We compare a single family rental against a duplex, triplex, or quad. We compare the vacancy risk. We compare the cash flow. We compare the reserves. We compare scalability on the property. And suddenly, the investor starts realizing that they've been looking at the wrong metrics. The goal isn't simply owning real estate. The goal here is owning real estate that supports your financial objective. That's the turning point here. The investors who understand this begin looking at properties differently. They stop shopping based solely on purchase price. Stop asking how much does it cost and start asking how can I get into that? They start evaluating income streams. They start analyzing risk. They begin thinking like operators instead of buyers. They become investors. And that's where real growth begins. Hey, if you're a veteran and you're looking to accelerate your real estate investing journey, I highly recommend checking out the War Room with David Perret. It's a community built specifically for veterans and active duty personnel who want to build wealth through real estate, entrepreneurship, and financial education. It is one of the best resources available for veterans who want to surround themselves with other veterans who are actively taking action. The link is in the description. If you need more personalized guidance, you can also reach out to me using buddevans.com. I do not sell a program. It is not a sales pitch. I will actually answer your questions. Now let's talk about how to evaluate small multifamily properties. One of the biggest mistakes here is that you assume that a duplex or a fourplex automatically produces better returns. That's not accurate. You still have to buy the property correctly. You still have to manage it correctly. And you still have to understand the market that you're buying in. The first thing that I look at is your gross rental income. What does the property actually produce today? Then I verify what the market rents are and use actual comps. Make sure you're using conservative. Don't listen to what a seller says. Don't listen to what the broker says. Look at what the market actually supports. The second thing I look at is the operating expenses for the building. What are your taxes? What does your insurance cost? What are you setting aside for maintenance and repairs? What does property management cost? Even if you're self-managing, put aside 10%. How much are the utilities? What are the capital expenditures going to look like? And what are you going to do when a property is vacant? Every one of those numbers matters. For vacancy, I usually use about 5 to 10%. A lot of inexperienced investors underestimate expenses and overestimate the rent. And that's how people get themselves into trouble. The third thing I evaluate is scalability. This is where small multifamily usually shines. Managing 4 units under one roof is generally more efficient than managing 4 single-family houses spread out across different zip codes or states, for that matter. In this case, we have one roof. We have one parking area. We have one lawn to deal with. We have one set of exterior systems. That creates operational efficiency. Look, as a property manager, I see this every day. The fewer moving pieces you actually have spread across multiple locations, the easier it becomes to control costs and streamline your operations. The fourth thing I look at here is financing. This is really important, especially for veterans. A lot of people don't realize that the VA loan can actually be used to purchase a duplex, triplex, or quad if you occupy one of the units. That's called house hacking. That means you can potentially acquire multiple income-producing units with little to no money down while living in one of them. And you only have to do that for a year. Think about that. You move into one unit, the other units help pay the mortgage, reducing your cost to almost nothing while you're building equity. You're gaining landlord experience, setting up your systems, and you're reducing your housing expenses to near zero, or you might even cash flow. You're creating a foundation for future investments. That strategy has lost countless successful investors. Now, let's discuss a common investor mistake. A lot of investors become emotionally attached to single-family rentals because they believe they're easier to sell later. Well, there may be some truth to that. They often ignore the income-producing value of multifamily properties. Experienced investors frequently purchase properties based on income, not emotion. It's about the math. If a property generates strong cash flow and strong returns, it remains attractive regardless of whether it looks like a typical suburban home or not. Remember, investors buy cash flow. They buy income. The stronger the income stream, the more attractive the asset will become. Another operational mistake is failing to build your reserves. Whether you're investing in single-family or multifamily properties, you need adequate reserves. A roof will fail. It's a matter of time. HVAC systems will break. Water heaters, they're gone in 12 years. Tenants are going to move. Markets will shift. Reserves create staying power. The more you set aside, the easier you're going to be able to absorb it. Staying power creates wealth. The investors who survive downturns are often the investors who have planned for them. And oh, by the way, if there is a market downturn and you do have substantial reserves, it gives you the opportunity to increase your wealth by buying. The investors who hoped everything would go perfectly fail. One additional benefit of small multifamily is accelerated learning. A fourplex teaches you property management faster than a single-family rental. You're going to learn really quickly about leasing, about tenant communications, and why driveway conversations don't exist. Maintenance coordination, vendor management, financial tracking. These skills transfer directly into larger investments later. In a lot of ways, small multifamily serves as the training ground for larger commercial opportunities. And that's why a lot of experienced investors eventually move towards duplexes, triplexes, or fourplexes as they gain their experience. And it's not because single-family rentals are bad, but because small multifamily properties often provide a better balance between scalability, cash flow, and risk management. So as always, as promised, here is your action checklist. Number 1, stop evaluating properties based solely on the purchase price. Compare vacancy risk between single-family and multifamily properties. Verify your actual market rents before you make offers. Analyze all of your operating expenses realistically. Make sure you're building adequate reserves before purchasing. Consider duplexes, triplexes, and quads for stronger income diversification. Evaluate whether a VA loan house hack strategy actually fits your situation or not. Focus on income and cash flow, not emotional attachment. If this video helped you out, do me a favor, hit that like button, subscribe, hit that notification bell, share this with your friends. I'm Bud Evans. Aim high, execute fast. See you on the next one.